Hello, everybody. So, my discussion, and I want to make it a discussion. I don't want to sit on the stage and talk and preach, but my discussion is pretty much the polar opposite of the speaker that was here before. I want to discuss, I hear feedback, I want to discuss business models. You know, the topic is supposed to be disintermediation. So for anybody who doesn't know what disintermediation is, it's basically taking the middleman out of the equation and letting two parties deal directly with each other. This is a very powerful concept and a very destructive concept because in much of Western civilization, where I'm from in the States, the largest lobby, the largest industry, most powerful industry is the financial industry. The financial industry makes all of its money from basically standing in between two or more people and taking a fee, a gatekeeper fee. So if you can disintermediate the largest industry by preventing them from standing in between two or more parties, then you change not only the way the world works, the way finance is done and investment is done, but you also alter the entire socio-economic structure. You know, you threaten those who are on top, you empower or potentially empower those who are on the bottom. So let's rewind that and bring it back to how disintermediation works. Okay, a lot of people think that disintermediation is a result of technology and a new technology coming to the forefront. And if you think that way and you believe in the blockchain, then you're like, wow, this is an opportunity, right? Let's go after the big guys. But that's not true. Technology has never, ever caused disintermediation. Technology has never taken out an industry, has never taken out a company. Now, in saying that, let's try and put some credibility behind it. If you Google my name, if you talk into your phone and say introducing Reggie Middleton video, you'll see a highlight of my proclamations, opinions, and calls over the last decade or so. I'm known, I got my claim to fame from calling the collapse of Bear Stearns, we call it Lehman Brothers, the housing crisis in the US, the commercial real estate crisis worldwide, the European sovereign debt crisis. I caused the rise, then drop of Apple, the rise of Google, the collapse of Research in Motion, which makes Blackberries, etc. All told about 85 to about 100 and change calls over the past 11 years. So I have a strong bent in both global macroeconomics and fundamental analysis. In other words, counting the money and seeing where the money goes and where it disappears from. So, assuming I know what I'm talking about, and assuming that my statement is correct, that technology has never caused an industry to collapse or a company to fall or a company to rise, then why does it happen? Does anybody know? Now we're going to get into the discussion part. Raise your hand, far and wide, if you know why industries fall and rise or why companies fall and rise. Take a guess. Yes. You got to speak up and project.
Technological breakthrough.
The what?
Technological breakthrough.
The technology, what?
Breakthrough.
Oh, breakthrough. Okay, but I was just saying that technology is not the cause of it. Now here's a hint. The technology paradigm shift, which is a massive shift from one paradigm to another, often is similar in time or predates the actual fall and rise of a company. But that's not the problem. What is it?
Where customers go. So where the customers go, that's where the change goes.
That's a good guess, but that's not it. So, you want to try it again or should I tell you? Go ahead, project, yell. You guys, yell. Employer greed. Okay, so it's actually a lot simpler than many people may think it is. It is the business model. Okay, it's business models that shift, that cause a large company to collapse or a small company to succeed. Now, these business models are enabled by new technology. You have companies such as IBM that made a lot of typewriters, or Royal, which was a typewriter company. It was the cream of the crop, okay? It sold most of the typewriters in the United States, possibly the world. I think it's Royal, I can't remember the name of it. Then we had a paradigm shift. So we had technology that enabled an electronic, purely electronic typewriter called the computer with a word processing software, right? It enabled a different type of business model so you could sell devices without the physical attributes of a typewriter. As time goes on, right, these word processors became more efficient right? And typewriters became obsolete, then you had companies that could come in and give the software for free and benefit off of something else. That caused the margins, the profit margins of this typewriter company to collapse, and they eventually went out of business. It didn't just happen to typewriters. If you take a look at cameras, right now, raise your hand if you have a portable camera in your pocket. Somebody raise your hand. Okay? Now, is this portable camera your cell phone? Raise your hand again. Okay? Not including your cell phone, raise your hand if you have a portable camera in your pocket. One person out the entire crowd. So, what happened to the portable camera market? Well, the technology of the integrated chip for the camera chip, the digital imaging chip, progressed to the point where companies were able to include this functionality in phones and not have to charge extra for it. Okay, that put the portable camera companies out of business. Now, it wasn't the technology that changed them, it was the business model, because you did not go and buy this stuff separately. This is all told for everything. Kodak, which was the company that made probably the most money from portable camera supplies, had the patent for the digital camera. Yet, they were put out of business. They were put out of business with the technology they discovered because the business model shifted. AT&T invented the cellular phone. Okay, AT&T now has to struggle for market share because cell phone companies actually take much of their revenues. The cell phone companies and the businesses that are built up top of cell phone companies, such as WhatsApp, Facebook, YouTube, Google, etc. So no matter how far back you go, whether it's recently or all the way back, you will see where it's always a business model that causes the collapse of a company. Now, with that short history in mind, we come and discuss my company. I'm the founder of Veritasium, which is a company that uses smart contracts in the blockchain and the altcoin, right, to enable peer-to-peer transactions through capital markets. Basically, we take the way things used to be, which is a hub and spoke model. You have a central bank, money center banks around it. You have an exchange. You have investment advisors, mom and pop shops, etc. Then you have investors. And these investors stand on this side. They have to go through many concentric circles. Central bank, money center bank, regional brokers, national brokers, etc. You buy a product. You go through and pay all these gatekeepers in the middle a fee. On the other side is the product, the producer of the product. So they produce, say, investment risk. It goes through all these middlemen. And on the other side, you buy that investment risk, but you have to pay all these fees, which is why you very seldom ever see anybody who saved their way to wealth. And think of all the wealthy people you've ever seen, the Forbes 400 list. How many people got to that list by using their savings account? 0. Okay? Now imagine if you can consume this produced risk yourself without having to go through 15 middlemen. That's what Veritasium allows, peer-to-peer capital markets. Now, we are able to do this because of this technology called the blockchain. We're able to do this because of smart contracts. Smart contracts are the ability to create an agreement, with a social agreement or legal agreement, through computer code. Okay, that's a simplified way of doing it. Using smart contracts, we replicate entire industries. We're picking the finance industry because it's low-hanging fruit. What makes the finance industry low-hanging fruit is that it's the only industry, besides being the most powerful industry in the Western world, at least in the US, and I think in much of the EU and the UK. Despite being the most powerful industry and lobby, it's the only industry where the employees make more than the owners of the company. Okay, between 35 on a very bad year percent and 60% of revenues goes to compensation, which means paychecks, bonuses, stock option, grants, etc. That's an inordinate amount of money. So if you take 60% of a company's revenues and you pay the employees, and then you only have 40% left to actually run the company, by the time you get to the actual shareholders, the people who own the company, it's a very small, de minimis amount. Now, that is a big red target. Not from a technology perspective, from a business model perspective. Because now, if I use a blockchain and smart contracts to enable you to do business directly with her, without any middleman, without any, and I'll name them, Goldman Sachs, JP Morgan, Morgan Stanley, Barclays Bank, Deutsche Bank, etc., you get to save an inordinate amount of capital. You don't pay any of these fees, right? You get full transparency. You get a built-in audit trail provenance by using the blockchain. Basically, all pluses. The only negative is someone stands to lose a lot of money. That's the in-betweeners. Those are the people who will be disintermediated, and that is basically where the capital goes. Now, judging by business models, and you agree with me that technology does not create the fall of an industrial paradigm, then how do we go after investment banks that have so much more capital? Well, if they have to pay 35 to 60% of their revenues to their employees, suppose we created a machine that does exactly what they do through the blockchain at 5% margin. Is it absolutely impossible for any bank or any financial institution that pays high compensation to compete? Every single financial institution, because of its culture, pays high compensation. That is the Wall Street culture. That is the same culture in the city, Bay Street, no matter what large metropolitan area you go to. So we have a structural deficiency. Remember I explained there was a structural deficiency in Bitcoin in terms of governance, right? Which is why I'm not as bullish on it as many are. You have a structural deficiency in financial services, in which it is impossible for them to compete with a well-put-together blockchain-based entity or program. This is guaranteed mathematically. As long as 60% is more than 5%, you will have one entity that cannot compete with another. Guaranteed disintermediation. Now, this is just financial services. If you take the same platform, the same way of doing business, peer-to-peer, a peer-to-peer economy, and you move it to any industry where there's a transaction of value between two people, or two entities, or two or more entities, and there's somebody in the middle who makes money between them, you could disintermediate them. That means real estate, insurance, healthcare, privacy, law, even politics. There is no industry that can withstand the forces of disintermediation as long as they're middlemen. Or, more accurately, as long as they're middlemen who don't add value. Now, there is a situation where you have a go-between, a middleman that extracts economic rent, a fancy term for getting paid for more than you deserve, where they have to remain in between. And the reason is because they're not really extracting economic rent. They're earning their pay. A good example would be, I'm driving my car down the street and I'm texting, and I hit this young man right here. I break both of his legs. Okay? I now call my criminal attorney and say, I really need some help. I hit somebody about texting, I broke his legs. It's very difficult to disintermediate the criminal attorney who knows what he's doing, because he can get you out of the situation or not. But if there was a criminal attorney who consistently lost all the time, and you could come up with a set of smart contracts to potentially do the same job with the same result, his job is suspect. He's gone. But as long as he does his job, he will always be a wanted middleman. If you look at most industries, that wanted middleman, the middleman that has to be there, is often either non-existent or very, very de minimis in terms of numbers. If you look at Wall Street, our system, and very tasty, we could go to our booth, and we're going to have an AMA afterwards, if you ask me any question, has performed above the level of most hedge funds anywhere near its stated investment goal. I did a demonstration of my actual personal exposures. Actually, we have it up here. This is not my account, but I did a demonstration of my exposures. For the last month and 5 days, I think we had 147% return. Okay, this is over a diversified portfolio of 9 different assets, all blockchain-based, okay? And it outperformed F by about 37%. And F has been on a tear for the same period, okay? Not only has it outperformed significantly, but you took less risk because of diversification, and you have full control over it. So at any time, you click close exposure, you can have the system go and sell these assets and return F to you at any time you want, or you could click another button, click close exposure for me. Okay, she's in spectator mode. So spectator mode is basically the ability to look at it but not to interact. The reason why we have spectator mode available is because I'm from the US and regulatory authorities in the US are very particular, so we had to make a read-only version of it. But at any time, if you get out of spectator mode by going to MetaMask and change your account, you can either get your Ethereum investment back, or you could click direct delivery, physical delivery. And that will actually allow you to take full delivery to the entire portfolio into your wallet. Okay, so not only does this make a super duper investment fund replacement, but it gives you the autonomous granular control of the blockchain. Okay, it does all this spectacular stuff plus more. If you look at the actual, tokens, these tokens are selected by our research staff. Our research staff is the same staff that assisted me in making all these calls over the past decade. These are the guys that helped predict Bear Stearns' collapse, Lehman's collapse, the European sovereign debt market. We called it country by country: Ireland, Portugal, Greece, and Spain, and the Italian banks, etc. We're focusing specifically now on digital assets. We issue reports ranging between 40 and about 75 pages per report. Each report is for a particular company, entity, or platform. If you go through reports, just scroll through slowly, take a look at the table of contents. This is the type of analysis that you simply don't see in the industry. Okay, I can sit here and with full objectivity and confidence say that our research is not only the best, but the second is not even close. There is no close second. That's not only including entities or companies that cover the digital asset space. You can take a look, go scroll all the way through, give them an example of what it looks like. Not only the digital asset space, you could compare our research to the best of the best, Goldman, Morgan Stanley, etc., on typical investments, such as Facebook, Google stock, on gold, commodities, etc. We go in depth, we have significant domain knowledge, and we have a strong track record. Each and every one of these research reports back a particular investment prospect. You feed it to our machine. It's called the VEDA, Veritasium Distributed Autonomous Interactive Research. It's fed into this machine, a collection of smart contracts, fully distributed. This machine then goes and purchases those tokens, creates a model portfolio, and gives you the opportunity to participate. So all you have to do is click a button, put the amount you want invested in, and the amount of time, and it replicates that model portfolio for you based upon this research, and voila, you have a vetted investment grade portfolio. Not investment grade, a vetted investment portfolio. And again, you have full control over it. You can do it anywhere from several minutes up to 99.9 years, and you can always break your own contract. Now, taking all this in consideration, we charge a flat 5% to get in. The reason why we charge flat 5% is because I'm well-versed in the financial industry, and I know exactly what price point to go in to create a disintermediary force. So at a flat 5%, that means that it doesn't matter if there's an entity that has a larger research staff than I do, potentially better research staff, not saying that they do. It doesn't matter how much capital or money they throw out of it. They cannot compete at 5% margins, okay? As a matter of fact, the only true product, the only true inventory of the financial industry are its employees. So if you go to a big investment bank, don't go pick on Goldman Sachs. Goldman Sachs only has its employees as human capital, and it has the tools that it's used, which is actual capital. So this is how the banking industry works. You take $10 million, you borrow $100 million, you have a $110 million portfolio, you're paying interest on this $100 million. Chances are this $100 million is a very, very small interest rate. For instance, it could be the checking and savings accounts and deposit accounts that savers go and bring to the bank. So they'll pay you 0.7% interest, maybe 1% on a good day. They turn around and take this $100 million and they go and invest it, or they spend it, and they receive, say, 20%. A good example would be a hedge fund owned by a bank. They charge 2% of invested assets. So if we invested $100,000 in here, they charge you $2,000 just to get in, and then they charge you 20% of all the gains. Now, if you take a look at a game, Eleanor, if you could go to, take off spectator mode and go to one of your actual exposures. I gave 147% as an example. We use one of mine because I don't know where we are here. She just formed these. So let's say 150% to round it off. So you took $100,000, you had 150% gain. That gives you $250,000 altogether. Goldman Sachs would charge you 20% of that $150,000 gain. So that would be $30,000 plus 2% of the whole total. Okay, so you're talking roughly $36,000 that they charge you. Okay, as compared to a flat 5% from this, which would have been $5,000. You have a dramatic difference in price. And the reason is you're doing business with a set of software smart contracts versus human beings who have quarterly bonuses, you know, yachts to buy, houses to buy, cash bonuses, etc. There is absolutely nowhere in the world a system based upon smart contracts that perform can ever be beat or matched by a human system that has to pay out bonuses. So this is the crux of disintermediation. Now, I want everybody to realize that we've been talking finance right now, but I explained this business model works the same across all industries. So our next industry we're looking would be real estate and commodity trading, okay? And we go around the world looking for opportunities to either become or to assist the producer of risk on one side or the consumer of risk. Assuming you're all investors, you're all interested in going to an application like this, most of you will be consumers of risk. So a producer of risk would be, we come to the government of Amsterdam and we see that a lot of people ride bikes, but maybe a high-speed monorail that connected Amsterdam and Rotterdam to allow the trip to happen in 25 minutes, right, would be superb. It would increase employment in Rotterdam. It will decrease housing prices in Amsterdam, okay, making everybody easier, happier. But it costs 250 or 500 million euros to build it. So you create an infrastructure project, right? We go into the back end of the VEDA. The back end of the VEDA enables you to spin up custom tokens and give them a specific value. So you go into the back end, you click very.monorail.rotterdam. That's a new token that's spun up, and that would represent 5% of the future revenues or future profits from that monorail built over the next 10 years, okay? A bunch of you come in, you buy those tokens. Now the government of Amsterdam and the government of Rotterdam can now take that capital and build that monorail. Okay, now the community, the constituents of Rotterdam and Amsterdam have created an investment, and that investment through the blockchain has been tokenized and was used to fund a monorail. Okay, this can be done on a granular basis. So unlike a typical bond, which may cost $10,000 minimum face value, you could go in at 45 cents. I'm using cents because 0.45 euro. Is that right? You could go in at 0.45 euro as a minimum investment, and the maximum investment could be untold. One entity could go and take the entire offering. So this is one example, again, of how you can use this software to disintermediate. Now, how is it going to disintermediate? Goldman Sachs would come in and make the same proposition, but they would want 6 or 7% of the entire deal's compensation, okay, where you can do it for literally decimal points to the system. That's one example out of many. Financing governments, you can finance farmers, you can trade your intellectual property, you can trade your privacy, you can trade used cars, you can trade your shoes, all by tokenizing it and bringing it through the blockchain. This is the world of peer-to-peer, the peer-to-peer economy as we see it. Are there any questions as I go on?
Hi, Reggie. If you apply your research to your token economics of the Veritasium token, can you maybe explain a little bit about that? And why, if I explore the Veritasium token, I can see there's 97.3% held by one address. Can you maybe explain a little bit about that?
Okay. I didn't hear the first part, but I'll answer the second part because I heard it. You want to ask the first part over again because I didn't hear the first part.
Oh, the first part was the token economics. Like, how do the token economics in Veritasium work, and how is the token life cycle, for example? Okay. And why is 97% locked in one address?
Okay. So the tokens, our business model, remember business model means a lot, is very different from the typical token offering. Our tokens represent prepaid fees for our products and services. So when you purchase a token, you basically purchase the ability to either purchase our services or enter our products on a prepaid basis. So that's the basic economics of the token. The reason why 97% are owned by one address, that address belongs to Veritasium, is because when we did the offering, only 2% purchased the token. Okay, that turned out to work very well for us because we felt that we have a strong competitive advantage. Now, to take a look and to give a background on that competitive advantage, my chief technology officer was also an intellectual property attorney. So in early 2014, we filed patent applications for the capital markets use of smart contract technology, and we filed it in every major jurisdiction in the world: UK, EU, US, Japan, and China. Okay, We filed before, to our knowledge, and we searched about 250 patent applications before every major technology company and every major financial institution. We haven't found any competitors as of yet, going back to 2008. So that, combined with the fact that we had an existing product at the time, combined with the fact that we have
there's economy, co-vesting, there's a lot of other projects doing similar.
Put your mouth a little closer to the phone. Say it again.
Oh, sorry. There's similar projects like economy or co-vesting, or there's multiple.
Right, but those are not similar. Economy creates a platform for others to create funds upon. We create a turnkey ability to purchase a portfolio, complete with research. Economy doesn't have fundamental forensic analysis.
They do.
They do?
Yeah.
Okay. I'll tell you what, though. After we don't have time now, you could come back to the booth. You could print out or show up Economy's research and compare it to ours. I am very confident that you could take our research and we could compare it to anything else. Okay, quite confident. If I'm not mistaken, Economy has passive index funds, which is not research. So they take the top 10 of, let's say, CoinMarketCap, and they create an index fund out of it. But if they have proprietary research, they have to look into it, and I'm happy to compare. Okay? Did I answer both of your questions? Yeah? Okay.
Like 97% lockup in the fund is great, but I don't understand the token economics of Veritasium. Is there a burn? Like if I buy a product, is there a burn?
No.
Or is it...
Okay, you know what it is? I explained. The tokens represent prepaid fees for products and services. It's a license. Okay, think of Microsoft Office. Microsoft owns 99% of their Office licenses. Okay, there's nothing negative about that. As a matter of fact, that's to be expected. Because in order for Microsoft to generate revenue, they have to sell Microsoft Office licenses. Okay, so if they own 99%, in order for Microsoft to succeed, they want to get down to zero within several years. They want to sell all their licenses. The more licenses they sell, the more revenue they generate. Now, if it's a platform, and this is platform economics, the more licenses that we sell, the more valuable the platform is. The more valuable the platform is, the more demand for the licenses, hence the more we sell. But remember, these tokens are software licenses. Okay, don't think of tokens, and I think you think of tokens as something like an equity security, where each token holder has to share a pool of economics, to share a pool of economic earnings. That's not the case. You don't share our economic earnings, there are no dividends, so there's nothing to dilute. So if it was a dilutionary effect, then it wouldn't matter if there's a concentration that someone can sell. But that's not the case here. Think of much more in terms of Oracle or Microsoft Office versus Google stock or Apple stock that may issue a dividend.
Okay, so with the tokens I can buy reports, and then the tokens will go to somebody who produces the report. That's the Veritasium Foundation.
You could buy reports for right now until we publicly release the beta. At that point, it's used to get into the beta. So the fee that you pay, the flat 5% fee, you pay in our token. Remember, the tokens, again, represent prepaid fees for products and services.
But then we'll go back again to your treasury.
Right.
You don't do any burn. So that means that the token, like the value of the token, it has a lot of value now, and it's great for you. But I don't understand as an investor why I would invest in.
Well, number one, let me address this clearly. We don't market the token as an investment. Okay. Number one. Number two, the token value runs concomitant with the value of the perceived services and products. Okay, so if you think that this is a valuable product and you want to put significant capital into it, and the only way to get capital into it is with a token that has scarcity, then that token will be perceived as higher value. If you believe that it doesn't have value, then the token will be perceived as a lower value. The value of Microsoft Office licenses has two large components. One is the perceived quality of the actual product. The other is the demand for the actual product.
Yeah, so that's an honest answer. So you basically say that the token doesn't represent any value, just access to the platform.
Well, I didn't say it doesn't represent value. I said it represents access to the platform. Access to the platform is value depending on the actual platform. Okay. For instance, if you take our research, you say Economy has research, I'll gladly join you afterward. Pull up Economy's research, you pull up our research, compare it, back to back. DCF analysis, addressable market, et cetera, et cetera. If one is superior to the other, then there'd be more demand and more value implied to the token, because the token is the only way to get into the platform. Okay, I'd like to take another question now, but hopefully I answered all yours.
Thank you.
Yes, there was another question here.
Thank you for your talk.
Put them a little closer, I'm hard to hear.
Can you hear me now?
Yeah,
Yeah,
go
there we
ahead.
go. So in context to the wider sort of talk of disintermediation, so one of the key things I see middlemen playing is that research function. And so sort of across the broader spectrum of property markets, financial markets, how do you see researchers being identified of trustworthy nature, and how are we going to find them to be able to make those transactions happen, which we now know can be done in a trusting environment?
When you say find them, define them so I know what you're talking about?
Find the researchers who can make the transaction happen. So if I go to an estate agent, I know they've got the tacit knowledge, they've got the insight into that specific property market. If I go to an investment banker, I know he knows about that, say, SaaS industry and what's going on in the industry. How are we going to reward those researchers, people of insight, and how are we going to find them and provide trust to then create a sort of seamless exchange on the blockchain?
Okay. Well, the concept of trust is lost in the financial markets. Most people do their investment through brokers and banks. Most people do not know how to vet financially these analysts that put the reports out. Most people don't realize how the system works. In reality, analysts or marketing and sales for the investment banking, underwriting, and trading staff. That's in reality. That's not how it's portrayed or sold. So the need for trust in financial markets is sort of a misnomer. Okay, that's the way it works academically in the blockchain world. That's not the way it works in the financial markets. But the way we approach it is we act as a platform only and a research arm only. So since we don't take a principal position, there's no conflict of interest. We don't have to lie to you about the prospects of our token because we underwrote it and we have a large position in it. So, the trust comes from the actual business model, and it's the actual business model that causes disintermediation. The Wall Street banks have inherent conflicts of interest because almost every company that they follow, they either underwrite, which is an extreme conflict of interest because there's a reason for them to lie, or they're seeking underwriting business, which again is a conflict of interest. Have I answered your question?
No, that's great. So do you think there's going to be a lot of splitting between, well, any party really that's providing insight and the transactional exchange? So we're going to see a lot of new actors in the research function coming up, maybe individuals from banks, and they're going to be providing, their own sort of projects that we should be now looking out for to reward and nurture into this ecosystem.
That's the way it should be. Unfortunately, the consuming market doesn't differentiate. So most consuming markets are very happy losing money, and they consistently buy products that lose money. Those markets that don't, family offices, hedge funds, buy-side institutions, actually need to make money because that's how they sustain themselves. That would be the market to start from. In a perfect world, you would pay a lot for research because research is worth a lot. In the world we have now, research functions are not self-sustaining because nobody outside of buy-side institutions are willing to pay for research. Buy-side institutions tend to generate their own research because they can't trust sell-side banks because of the conflict of interest. The retail consumer, expects to get taken advantage of, so they can do that, and that's basically a source of revenue for banks. We're looking to show a different way. Okay, once we gain, again, this is an example of platform economics. She has a question up front. This is a question of platform economics, so the more people that use a platform, the more valuable a platform is. Because we have very low expenses, we can grow and expand very, very quickly. Okay, and there is no conflict. I purposely scale this so there is absolutely no conflict of interest. So even if you couldn't trust me, you don't have to because my goal is to provide a transaction platform and separately research. And one of them will probably end up being free, or not free, but incorporated into the second. So if the research is incorporated into the use of the platform, all you have to do is just pay to get into the platform, and it's done.
Yeah. Good,
Okay.
thank you, Reggie.
Sure.
Thank you so much
Okay.
for your presentation.
Okay.
If there are more questions, you will be here the whole afternoon, right?
I'll be here all afternoon.
Perfect.
Can she squeeze in since she's... Yes, no?
One last question.
Okay.
Just an observation. You talked about the banks would be affected mostly by the blockchain technology and what we're offering. But if the bank was paying out 60%, I was just thinking about that, 60% to employees, and before all their other expenses. Shouldn't they be liking this blockchain technology to get rid of all the 60% employees?
That's a good question. But the problem is, he's Morgan Stanley, he's JP Morgan, and she's the third bank, let's say Deutsche Bank. So if he decides to drop his compensation down to something realistic, where do all his employees go? To the other banks. If they decide to drop, then they go to Asia, Daiwa Bank. If Daiwa Bank drops it, then they go to London. So in order for the structural deficiency of the financial industry to really cure itself, everybody has to uniformly drop compensation. That will never happen. Greed, management greed, as was stated before. So either you change human nature, or a system like this breaks the banking institutions that don't change their business model.
Thank you, Reggie.